If you picture the stock market, you probably imagine a room exactly like this. Hundreds of people shouting over each other, staring at giant boards of flashing numbers, and trading complex financial products that seem completely out of reach. And when it comes to trading options, that feeling of overwhelm usually gets worse. It is easy to assume you need an advanced math degree, or that you have to spend your days staring at a spreadsheet just to grasp how they work. But an option is actually incredibly simple. Think of it as a financial coupon. It gives you the right to buy or sell something at a locked-in price by a specific deadline. And crucially, it gives you that right without forcing you to actually make the purchase. There is no abstract calculus involved here. At its core, an option is just a basic agreement. You have likely used the exact same logic in your everyday life without even realizing it. Imagine you are house hunting. You finally find your dream home, and the seller wants exactly $300,000 for it. The only problem is, it is going to take you 3 months to gather the cash you need to buy it. If you just wait 3 months, you run into 2 big risks. Another buyer could walk in tomorrow and scoop it up. Or a new train station could get approved down the street, and the seller might suddenly raise the asking price to $400,000. To solve this, you make the seller an offer. You hand them $1,000 in cash right now, non-refundable. In exchange, they agree to hold the house for you at that original $300,000 price for exactly 90 days. That single piece of paper gives you total control. You have secured the choice to buy the house later at a guaranteed price, and you did it by spending a tiny fraction of the total cost up front. This diagram shows how a real estate contract is a call option. The vocabulary changes, but the mechanics stay the same. The deposit is the premium. The guaranteed purchase price is the strike price. That window is the expiration date. That is all an options contract is. It is a legally binding agreement completely defined by those 4 specific variables: the type of option, the premium you pay, the strike price you lock in, and the date it expires. Let's look at what happens when things go well. If the neighborhood property values skyrocket and that house is suddenly worth $500,000, your contract still lets you buy it for $300,000. You can buy at the discount, sell at the new market rate, and pocket the profit. Now imagine the worst-case scenario. A sinkhole opens up on the street, and the house's value crashes to 0. This visualization compares your risk. If you had bought the house outright, you would have lost $300,000. But because you only bought the option, you simply walk away, and your total loss is strictly capped at the $1,000 premium. The market also offers a tool for the exact opposite situation, known as a put option. A put gives you the right to sell an asset at a locked-in price. It works just like an insurance policy, paying out if the price of an asset drops. By using options, investors can separate the heavy obligation of owning an asset from the financial potential of its price moving up or down. Leverage is the primary reason professionals trade options. The standard rule: one contract controls exactly 100 shares. Buying 100 shares outright costs tens of thousands of dollars, but buying one options contract to control them might cost a few hundred. The second major reason is hedging. Much like buying insurance for your house against a fire, traders buy put options on stocks they already own. If the market takes a sudden dive, the rising value of the put option offsets the severe losses in their portfolio. Options serve as strategic tools for capital efficiency and risk management. Using them allows a trader to define exactly how much they are willing to lose before a trade even begins. However, that power comes with a severe catch: time decay. You can hold a standard stock forever, waiting for the price to recover, but options are constantly fighting the clock. If the stock does not reach your target strike price by the deadline, the contract expires entirely worthless. Because of that ticking clock, there are golden rules you need to survive the market. Rule 1 is capital protection. Never use money needed for rent, groceries, or daily living to trade options. The second rule is to keep your risk contained. When you start out, stay on the buyer's side of the contract, where your loss is strictly capped at that initial deposit. You want to avoid acting as a seller who promises to deliver an asset without actually owning it yet. That move can leave you responsible for a debt that grows as high as the market price climbs. Rule 3 is to practice the mechanics first. Use paper trading simulators. These let you practice with real market data using fake money, allowing you to learn the interface before risking actual dollars. Options offer immense flexibility and control.
As long as you respect the absolute finality of the expiration date, these tools allow you to participate in market moves with far less cash than it takes to buy an asset outright.